Modern business relies on shared economic activity. Companies combine resources to build public-private infrastructure concessions, fund research pipelines, and operate heavy industrial co-development projects. The contracts for these projects usually carry clear titles. They are called strategic alliances, consortiums, or joint ventures. But for financial reporting, those commercial labels are meaningless. The governing accounting standard, IFRS 11, bypasses legal titles entirely. Its central objective requires an entity to report its interest based strictly on the actual economic rights and obligations created by the arrangement. Before the standard existed, older frameworks allowed companies to use proportionate consolidation for joint ventures, effectively choosing how much of a shared project they wanted to report. IFRS 11 closed that option, replacing it with a rigorous classification model. Relying on a contract's cover page rather than its economic substance distorts a parent company's risk profile. It allows entities to offload massive operating debts into shared structures, hiding true financial exposure from investors and lenders. To fix this, IFRS 11 forces every shared arrangement into one of two strict reporting categories. The path a company lands on dictates entirely different balance sheets. The first classification is the joint operation. Here, the reporting entity must recognize its exact share of the project directly. It records its specific cut of the assets, liabilities, revenues, and expenses, line by line. This direct recognition bloats the parent company's financial statements. The parent absorbs the raw operating scale of the shared project directly into its own metrics. The second classification is the joint venture. This mandates a single-line investment recognition using the equity method. The investor records a net investment position, not a direct share of every underlying asset and debt. These two outcomes create vastly different analytical profiles. Joint operation accounting increases gross presentation, heavily impacting gearing ratios and asset intensity. Joint venture accounting presents a cleaner, albeit more condensed and opaque, picture of residual investment exposure. Because the resulting metrics alter how markets evaluate debt capacity and operating scale, the boundary between these two classifications requires precise, forensic navigation. Before reaching that classification, an entity must pass the first gatekeeper of the IFRS 11 logic tree. The parties must prove that joint control actually exists. Shared activity alone is not enough. Providing shared funding, holding minority vetoes, or having board representation does not equate to shared control. Under the standard, joint control exists only when decisions regarding the relevant activities require the unanimous consent of the parties sharing control. But what exactly are relevant activities? They are the specific operational choices that drive the economic returns of the arrangement. In a resource extraction project, relevant activities mean setting the extraction volumes, managing the underground reserves, and determining the environmental site restoration plans. If one party can dictate these specific activities without requiring unanimous agreement from the others, joint control does not exist. The arrangement falls entirely outside the scope of IFRS 11. This strict unanimous consent boundary prevents companies from hiding unilateral control. If you have the sole power to direct the return-driving activities, you carry the associated liabilities, and you cannot disguise the project as a shared cooperative venture. Once unanimous consent is verified, we move into the classification engine. A joint operation means the contract gives the parties direct rights to specific assets and direct obligations for specific liabilities. A joint venture means the contract gives the parties rights only to the residual net assets of the arrangement. The initial directional indicator for this classification is legal form. Assessors look at whether the arrangement is a standard partnership, a trust, or an incorporated company. But IFRS 11 requires a broader test. Contractual terms can override the vehicle's legal separation. Consider a 100% take-or-pay offtake agreement. The parents create a separate vehicle for a power plant, but sign a side contract guaranteeing they'll purchase all the electricity it produces. Under the IFRS 11 asset test, if the vehicle exists primarily to supply output to the parents are consuming substantially all the economic benefits of those underlying assets. Under the liability test, if the vehicle relies entirely on the parents' guaranteed purchases to generate the cash flow needed to pay its creditors, the parents carry the true economic burden of the debt. The economic substance dictates the result. Despite the corporate shell, the arrangement must be classified as a joint operation. The parents are forced to recognize the gross liabilities on their own balance sheets. IFRS 11 forces auditors to pierce the corporate veil. A legal structure cannot be used to off-balance sheet true economic exposure when side agreements and guarantees mandate otherwise. Proving this classification in practice requires strict documentary evidence. Reading the title of the primary agreement is insufficient. The audit trail demands a full legal breakdown. Auditors must hunt for side letters, bank guarantees, offtake contracts, and liquidation rights. Small wording differences in these secondary documents often completely alter the balance of risk. An incorrect classification at this stage infects the entire reporting chain. It corrupts downstream impairment testing, deferred tax calculations, and critically, the measurement of debt covenants. Applying IFRS 11 is a forensic exercise. The final accounting result maps directly to enforceable legal liabilities, ignoring management's stated intentions. Finally, classifying a joint arrangement is not a static one-time event. Major life cycle changes to a complex infrastructure project will always require a mandatory, complete reassessment of the entire logic tree. Transitioning a site from exploration to active production or amending an output pricing strategy changes the underlying economic facts. Admitting new partners or refinancing debt can alter unanimous consent thresholds overnight, instantly flipping a project from a joint operation to a joint venture. Preparers carry a heavy burden. They must continuously monitor the operational reality of their arrangements against the strict definitions of the standard. By stripping away the illusion of static legal structures, IFRS 11 ensures that a company's balance sheet reflects the raw truth of its shared economic risks at every stage of a project's life.